You didn't buy this property to work two jobs, but here you are spending your Tuesday nights on the plumbing calls. Your Saturday morning isn't at your kid's soccer game, it's chasing down Unit 4's late rent payment. Again, your phone buzzes at 9 p.m. and your stomach drops before you can even look at the screen because you know it's either a tenant emergency or a property management company asking for another approval. You got into multifamily because someone told you it was passive income, financial freedom, build wealth while you sleep. But right now, it feels like the building owns you more than you own it. And here's what no one's telling you. This is a specific stage in the ownership life cycle. I call it the frustration peak. And the truth is, the ending of your story, whether you build massive wealth from this property, just burn out and sell it for less than it's worth, depends entirely on what you do in the next 90 days. My name is Justin Ferguson, and I'm a multifamily broker here in Virginia. I've helped hundreds of mom and pop owners navigate this exact moment, the point where the romantic vision of mailbox money crashes into the reality of being an unpaid property manager, amateur accountant, and a part time HVAC technician. See, this is video one of 9 where I walk you through the entire journey of a mom and pop multifamily owner. From the moment you realize something has to change, all the way through valuation, debt strategy, positioning, and the closing table. But today we have to start where it hurts, the frustration. Because if you don't acknowledge why you're tired, if you don't understand what's actually breaking down in your operation, you're going to make a reactive decision that costs you 50, 100, even $200,000 in equity you didn't even know you were leaving on the table. So let me tell you about Linda. Linda bought a 12-unit building in Richmond back in 2017, paid 720 for it. Market was decent, rents were climbing, interest rates were still reasonable. Her loan officer told her, with proper management, this thing will cash flow 3,500 bucks a month after expenses. And for the first year, it did. Linda felt like a genius, but then the water heater in building B went out. 8 grand. 6 months later, the parking lot needed paving. 14 grand. One of her longest term tenants moved out, and the unit sat vacant for 2 months because she didn't have a good system for marketing it. Lost rent, $3,200. Suddenly, that 3,500 month cash flow was getting eaten up by capex surprises she hadn't budgeted for. And because she was self managing, because she wanted to save money on property management fees, she was the one fielding the 11 p.m. maintenance calls. She was the one driving over on Sunday mornings to show units. She was the one dealing with the tenant in Unit 7 who hadn't paid rent in 45 days and kept giving her excuses. By year 3, Linda wasn't building wealth. She was babysitting a $720,000 headache. If this sounds familiar, I want you to understand something critical. You're not failing, you simply reached the natural limit of the DIY management model, and this isn't a character flaw. It's a structural issue. Let me break down what's actually happening here. When you're in this stage, you're dealing with 3 compounding problems. Problem number 1, management friction. See, you are too accessible. Tenants have your personal cell phone. They text you at all hours. They bypass any formal process because it's easier to call you directly. This creates an environment where every minor issue becomes your emergency. You can't delegate because you built a system where you are the system. Problem 2, the capex creep. Most mom and pop owners dramatically underestimate reserves. You think you're cash flowing what 3 grand a month, but you're not properly accounting for roof replacement, the HVAC systems hitting end of life, plumbing under the slab, electrical panel upgrades. So every time you start to build a little cushion, something expensive breaks. That you don't have time to actually analyze whether this property is still serving your financial goals. You don't review your rent comps, you don't monitor market cycle positioning, you don't evaluate whether you'd be better off selling this asset and reallocating into something that fits your current life stage. You're in survival mode, not wealth building mode. And here's what Linda didn't realize. Her frustration wasn't about the building itself. The building was fine. The fundamentals were solid, decent location, reasonable rents, stable tenant base. Her frustration was about the client stack, the way she was holding it. Here's where most owners go wrong. When they hit the frustration peak, they do one of 3 things. Option A, they ignore the problem. They convince themselves it's just not that bad. I just need to push through. So they keep grinding, keep sacrificing weekends, keep answering tenant calls at 10 p.m. Meanwhile, deferred maintenance starts piling up. The property slowly deteriorates. Rents fall behind the market, and by the time they finally decide to sell, they've lost years of appreciation and operational upside. Option B, they panic sell. They get so burned out that they take the first offer that comes in. Some we buy houses wholesaler cold calls them, offer them 850 grand on a property that should be worth 1.1 million, and they just take it because they're just done. They leave 200 grand on the table because they didn't position the asset correctly, didn't time the market, didn't understand their actual equity position. Or option C, they make the decision emotionally instead of strategically, without first asking, what is this property actually worth? What's my loan position? What's my basis? What are the tax implications? What's happening in the market cycle right now? And what most importantly, what do I actually want to do with my life? And Linda almost made that mistake. She was about 3 weeks away from listing with a discount broker just to get rid of the headache. When a friend of hers, another investor, told her, before you do anything, talk to someone who understands mom and pop exits. She called me, and the first thing I told her was stop. Don't list this property yet. Not because I didn't want the listing, I did, but because she was making the decision from the wrong emotional state. She was acting out of frustration, not strategy. And frustrated sellers always leave money on the table. Here's what I told Linda, and what I'm telling you right now. The frustration you're feeling, that's not a problem, that's a signal. It's your gut telling you that the way you're currently operating this asset doesn't match your life anymore. Maybe it worked when you bought it, maybe it worked for the first few years, but something has shifted, either in the market, in your financial goals, in your personal bandwidth, or in the property's operational demands. And that signal is actually valuable information because it means you're ready to move on from reactive ownership to strategic ownership. But before you can make any move, before you sell, before you refinance, before you reposition, you need clarity on three things. One, what is this property worth in today's market? Not what you paid for it, not what Zillow says. What would a sophisticated buyer actually pay for it right now, based on current rents, current cap rates, and current market positioning? Two, what is your true equity after debt, after taxes, after transaction costs? Because a 1.1 million sales price doesn't mean you're walking away with 1.1 million. You need to understand your net proceeds, the actual cash you'd have available to redeploy or take off the table. And three, what are your goals for the next 3 to 5 years? Do you want to simplify and reduce headcount? Do you want passive income or do you want liquidity? Because the answer to should I sell depends entirely on what you're trying to accomplish. Linda and I spent about 90 minutes working through those three questions, and by the end of that conversation, the frustration was gone. Not because the property changed, the property was still the same, but because she finally understood her position. She knew what it was worth, she knew her options, she knew what made sense for her life. And once she had that clarity, the decision became obvious. Here's a mistake I see mom and pop owners make over and over again. They feel the burnout, and their first instinct is to ask, should I sell? But that's the wrong question, because if you ask that first, you're making a decision from emotion, not strategy. You're reacting to the stress instead of evaluating the fundamentals. See, the right question is, what is my best move from here? Hold, refinance, or sell? And the answer to that question, you need a framework. You need to understand the three-way decision tree that sophisticated investors use to evaluate their position in the market cycle. That's exactly what we're covering in video two. I want to walk you through the I'm going to walk you through the hold versus refinance versus sell framework, the same one I use with every mom and pop client who hit this frustration peak. We'll look at the current debt positioning, market timing, tax strategy, and how to structure your exit or your hold in a way that maximizes your equity and minimizes your stress. If you're sitting here thinking, I don't know if I should keep this property or move on, you need to watch that video before you call a broker, before you list it, before you make any move. I'll see you in step two.